Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Tuesday, March 4th. If you read about the market long enough, you'll inevitably run across adages like, the trend is your friend and don't fight the tape. These are adages meant to convey the idea that you should follow the crowd. To be sure, it's hard not to follow the crowd when it looks like a lot of people are making a lot of easy money. The fact of the matter is that things are never as easy as they seem to be trading the capital markets. If they were, everyone would quit their jobs and simply play the market for instant wealth creation. Some people, to be fair, are expert traders and make a ton of money as a result of their skill. Most people, however, are not, and they end up losing more money than they thought possible. For these people, though, the issue isn't so much about getting into a trade as it is about knowing when to get out of one. Plenty of investors came face to face with that reality when the internet bubble popped. They eagerly purchased technology stocks on the way up, along with many others, making for a very crowded trade. In other words, everyone seemed to be buying the same thing while maintaining the same belief they were certain to make a lot of money, since asset prices, technology stocks in this instance, only knew one direction. Technology stocks, of course, came crashing down along with the paper fortunes of countless investors. Ironically, that implosion helped drive another speculative fervor. This time it was in the housing market, which took off nationwide on the back of low-cost financing. We won't expound on the subsequent housing market meltdown, but it proved to be near the beginning of the end when TV shows started to pop up that made flipping a house look as easy as flipping a pancake. We see today, too, just how crowded the housing trade got, not just on the home flipping side of things, but primarily in the ownership of mortgage-related securities. As those securities have been marked down in price, the subsequent fallout has been significant in a direct way for institutional holders and in an indirect way for retail investors. The painstaking consideration today is that loss estimates of as much as $600 billion suggest we are only about a third of the way through the subprime-related write-downs. If you look hard enough, or not even that hard in some instances, you can find evidence of crowded trades. These trades come about when everyone is talking about the merits of owning the same thing. We saw this in the tech sector's four horsemen last year: Research in Motion, Amazon.com, Google, and Apple, which gained 166%, 135%, 133%, and 50% respectively. Any guesses as to how the aforementioned stocks are faring so far this year? Well, RIM is down 12.6%. That's not bad, relatively speaking. But Amazon is down 32%, Apple is down 39%, and Google is down 37%. The big trouble with a crowded trade is that declines escalate in a hurry when the people that got into the trade all decide they want out at the same time. In these cases, the market doles out another painful message, which is that stocks go down in price a lot faster than they go up when these crowded trades fall apart. So where's the popular crowd hanging out these days? Commodities are as hot a spot as any right now that seems to be drawing more and more of a crowd as the stock market suffers. In turn, the Treasury market has quite a crowd too that has been working to escape riskier assets amid the economic uncertainty. That risk aversion has been so great that a number of investors have been willing to buy 10-year paper with a yield near 3.5%, which is below the annual inflation rate of 4.3% seen in the Consumer Price Index. Now, it should be noted that asset prices can stay overbought for extended periods of time, so this isn't to say commodity prices and Treasury prices are due to collapse imminently. Consider it a warning, though, that following the crowd can be a costly pursuit. With the latter in mind, you might want to take stock of another Wall Street adage, which is that pigs get fat, hogs get slaughtered. The translation: don't get greedy. Taking some profits on the way up is advisable, lest you want to incur the increased risk of losing your capital when a crowded trade suddenly becomes less crowded. I'm Pat O'Hare for Briefing.com. Thanks for listening.